to speak with you. Glad to be back here today. We're going to be speaking about private equity and mergers and acquisitions, and we've got quite the panel for you. Jack Isaacs, who is sitting there in person, waving his hand, Empower Growth Capital. He's an independent sponsor, so that'll be a very interesting view. George Jones, who is on the video. George, if you want to give a little wave, there you go. He's managing director of Woodside Capital Partners, a very well-known investment banking firm, especially on the West Coast. Nishita Cummings, who is also on the video. There she is. She gave you a nice little wave. Managing partner and co-head of growth capital at Kayne Capital, a growth capital firm. So, and then did I hit on Tanya yet? Tanya Viner, shareholder at Buchalter. She is there in person. Tanya is the co-chair of mergers and acquisitions practice. She also speaks Russian and Ukrainian. So today is sort of a test for everybody. When she answers, half the time she's going to answer in Ukrainian, half the time in Russian. We're going to see who can identify the differences. My name is Mark Heil, and I've been involved in the alternatives since the mid-1990s. Yeah, I've been involved in marketing, capital raising, fund administration services, and helping people use their retirement dollars to get into it. So I've seen this industry from a lot of different angles. It's going to be great to have this discussion today with this panel. For the next 50 minutes or so, we're going to talk about, take a real deep dive into private equity and mergers and acquisitions for the remainder of 2023 into 2024, 2025, from finding and sourcing deals all the way through to the exit. Particularly interested in our panelists' views on current opportunities, risk, how they work with their companies in good and bad or good and challenging markets. We invite you to be part of this conversation, chip in with comments or questions. There's a lot to cover here this afternoon, so I ask you to be efficient when you're asking your questions. And with that, I would like to get our panelists to introduce themselves. So, Jack, I'm going to start with you. If you would just do this and maybe tell us a little bit about your background. Tell us, about Empower Growth Capital and how you got into this business.
Yeah, sure. Thank you. Again, my name is Jack Isaacs. My firm or my group is Empower Growth Capital. I started as a lawyer. I practiced for about 15 years. The last place I practiced law was a technology in Silicon Valley called Macrovision. They were kind enough to pay for my MBA, and I was kind enough to leave them and move into private equity. So I've been in private equity now for about 17 years, which has been a joy and a pleasure. I started out at Kayne Anderson, where Nishita is currently a managing director and partner in the firm. Actually, Nishita and I worked together for a number of years. She was easily the smartest associate I ever had. I had the opportunity to work with. She's absolutely brilliant. I was really looking forward to seeing her again. Unfortunately, the way this is set up, I actually can't see her. I have to turn around to look. Let's see, my fund. Actually, I'm a sponsorless fund, as was mentioned. I look to do kind of one-off deals and then bring them to family offices and related people that I have gone to back on a regular basis. I'm focused on technology. It was very interesting to hear the last panel. Early stage businesses. I'm looking at recurring revenue. So really anything in the recurring revenue space, kind of $5 to $15 million in recurring revenue. And I'd like to be a minority investor, which is somewhat unique for private equity. It tends to be much more venture capital focused, that kind of minority investments. But I like to team up with management teams and help them grow and then help sell them. And so it's been a fun model for me and a pretty dynamic workspace. I've been looking at a wide variety of different industries that have recurring revenue. I think.
Well, that is perfect. I think you've done a great job. George, why don't you take a minute and just tell us a little bit about your background and about Woodside Capital Partners.
Sure, happy to, Marty. Mark, excuse me.
Sorry.
I'm a managing director at Woodside Capital. We're I guess I would call us a boutique tech-focused investment bank headquartered in Palo Alto. We've got offices in Zurich, New York, and LA. The practice for me is largely semiconductors. I lead the semiconductor practice in the firm, and I'll tell you a little bit about my background. Sort of leads me to this focus. Educationally, electrical engineering from Georgia Tech, did an MBA at Wharton in the dark ages, I would add, and have been in Silicon Valley for a little over 40 years, and 5 startups, mostly semiconductor oriented. I'm also a founding member of Sand Hill Angels, one of the larger angel investment groups in the country these days. And we've been going this is our 23rd year. So I'm not as active in the group as I used to be, largely because the investment banking practice at Woodside has really taken off. The nature of the deals that we get varies. We do quite a bit of sensor work, semiconductor-based sensors, complex chips of various kinds, and specialized chips. And the manufacturing space has also become a pretty hot one for us. CHIPS Act and the equivalent kinds of initiatives in the EU and other parts of the world are driving quite a bit of capacity increase. So there are an awful lot of small to mid-sized companies that would like to find another home. Our focus tends to be companies that are in the $30 million to $300 million valuation range. The practice is largely M&A. We do a little bit of capital raise, but usually the focus is for the purposes of sale of company. Mark, does that give you a flavor for it?
I think that is terrific. And by the way, my mother, I'm one of 4 boys in the family, and my mother had to always go through the whole entire list to get to my name. So perfect there, George. Nishita, why don't you take a couple minutes and tell us about your background and particularly, Kayne Capital and what you're doing there.
Sure, happy to. And Jack, I'm sorry, I'm not there in person. Would have loved to see you. I was told that most of the panelists were going to be on Zoom, so I didn't want to be the solo one that was in person. But as Mark mentioned, Nishita Cummings, managing partner and co-head of the growth capital strategy here at Kayne. To give you background on the organization itself, Kayne Anderson's been around since 1984, managing about $35 billion under management, really spread across 4 investment strategies. One is oil and gas and renewable investing. The other real estate, direct lending is the third, and our practice, which is the growth capital group, which started kind of post.com in 2002. And sort of since inception, we've really been focused on investing in technology and tech-enabled service businesses. And what we define as that landscape where we partner with management teams, either on a non-control or control basis. So we do both. Are companies that are doing roughly between 10 to 200 million in revenue when we get involved. And we have equity funds as well as credit funds that we work out of. I think that I would like to say that we had a crystal ball and knew what was coming when we raised our last growth credit fund, which was last year in summer 2022. But it was just fortuitous and well-timed, considering what has gone on in the tech markets, as well as the credit markets. But either way, within our equity funds and our credit funds, we're looking at the same type of businesses. We really focus on what is the value proposition or the ROI that these companies are delivering to their end customers. And then really, from an origination standpoint, spending a lot of time on specific areas where we feel we have an expertise from an industry standpoint. And that's a lot of our sourcing and origination comes from that deep dive within certain sectors in technology, where we partner that with our operator network that we put in place. So our operators not only help us originate, but they also sit on the boards of the companies that we invest in, along with the investment teams, and are adding value along the way. So they're industry experts as well as functional role experts. And then we also roll up our sleeves and are very hands-on operationally. That could be from business development, corporate development, but also really thinking about how we drive efficiencies. So we have an entire vendor and value add procurement arm where we contract with the mothership, so the $35 billion organization, and bring those synergies and best practices and best service groups down to the companies we partner with.
Fantastic. Thank you. Tanya, why don't you take a few minutes and just tell us about yourself and Buchalter and your M&A practice there?
Sure. I'm actually a late addition here, so thanks for the opportunity. I'm just really here to keep Jack company. So he's not here own. I've been at Buchalter for 17 years. I'm the co-chair of the mergers and acquisition practice of Buchalter. We have a really dynamic practice. We do both public company and private company M&A all across all of our offices, as well as clients in other states too. I also do cross-border transactions as well. We really focus on middle market M&A. So anywhere size range from, as small as 10 million to as large as $1 billion transactions. And I see myself more as a generalist, but we've done so much in the consumer product space, and we have really a lot of clients in that space that we both do M&A work for, as well as general corporate work, both buy side and sell side deals as well. So
Fantastic. Thank you for that. George, I want to start with you, if you don't mind. In 2021, a record number of deals were done, something like 65,000. Last year, 2022 was down slightly, 9% or so, but still, historically a fantastic number. We're now a quarter and a month into 2023. What would you describe the M&A environment like right now?
Slightly turbulent, generally down in terms of quantity, but the thoughtful buyers out there see it as a tremendous opportunity. Valuations are down, as you might guess, and so there are an awful lot of companies. If they're venture backed, they completed a Series B in 2019, 2020, 2021, or a Series C, and the prospects for the next series are not great. So many of those companies are seeking M&A as a legitimate alternative, and the level it's almost at a fever pitch in some cases. They if they've got a finite runway, 9 months, 12 months, 18 months, whatever it is, thoughtful CEOs are thinking ahead about M&A. Now, on the flip side, the strategic buyers whose balance sheets have been decimated in the last year, in some cases have just gone dormant. So we're seeing fewer of those than we did even 9 or 12 months ago. But thoughtful programmatic buyers are extremely active. So we're getting they just both push and pull with entities like that. And that includes several classes of PE entities. I mean, they're, where there's a theme for a roll-up, for example, and we've got a portfolio or got a client that fits that theme. In terms of interest in engaging, it's almost a slam dunk. Valuations and terms and, does it really fit and all that stuff comes in diligence, but the interest is there and pretty active. We're seeing a growing number of search funds out there. The success rate, financial success rate of search funds that come out of Stanford, for example, are just extraordinary. And we're seeing replication of that model from other top B schools. And I'd say with regard to there are government effects, particularly the CHIPS Act, that are also driving interest, and it's multi-part and in a rollout stage with respect to the CHIPS Act. So the first thing they did was focus on manufacturing. So we've got several manufacturing oriented things going on that space, and expect probably through partnerships or combination post M&A to be able to benefit from some of those incentives.
Great. Well, thank you. Tanya, I want to toss it over to you as well, because you probably see a wider variety of companies than a lot of people. What are you seeing out in the market?
I mean, probably similar outlook. Things are, I wouldn't say turbulent, but it's choppy, I guess, the same word for turbulent. We see sellers that are, I would say over the course of the last year had these really high expectations as to what the valuation for their business should be and could be, because all of their friends were selling in 2021 for enormous value. And now they're sort of coming to understanding that, hey, the debt markets have changed, the valuations have changed, the economy has changed, they have to calm down from their expectation. There's a lot of opportunity for buyers, you're right, especially those that are, looking at businesses for roll-up or a future strategy and growth. But, I would say I think also from our perspective, the deal transactions and the structure has changed as well, right? Whereas sellers were expecting all cash values, right, a year or two ago. Now there's the earnout components, seller note components. There's a lot more uncertainty as to how much you're going to be getting upfront. And I think our buy-side clients are also really mindful of that and are looking for value too, right? They're looking for an opportunity and they're looking for value. They still have a lot of cash to deploy. So I think it's just more about being really meaningful to come out there and try to get a good result.
Talk to me a little bit about the speed of transactions, if you would. And you know, George, I'm sorry, Jack, if you want to jump in here too, please do.
Mark, I got a question.
Marty has a question.
So I'm hoping you kind of brought up some great points about like earnouts and things like that. Are there any, given the current climate, and I look at it as there's a huge wave of people looking to retire and get out of their business one way or the other.
Yeah.
And I have a guy who turned around a business. Originally, he had set a price of several $1 million to buy the business. And then when COVID hit, the guy, and he actually did turn it around. When COVID hit, the guy came back to him and says, you can buy it for 10% of the price and an earnout, right? I mean, I just had a lot of dramatic things started happening because of COVID, and now it's just as dramatic because of interest rates, because this dollar carry trade is over. You can't leverage up as much as you used to, right? So maybe there's other aspects you guys need to talk about of what expectations people should be thinking about when they're doing a deal, but earnouts, self-funded debt, you know, things like that.
Yeah, I mean, seller note, right? Like that's in some way self-funded debt. I mean, I think that, you know, the example you give is a good one, right? Like somebody who's thinking about retiring, they're also looking at a risk factor, right? So saying, hey, maybe I should have sold a year or two ago, but I didn't. Now at this point, maybe I'm not getting what I really wanted to get, but am I willing to take on additional risk and continue holding on to this company? So this could be a great opportunity, I think, for a buyer, you know, if you sort of have a really nice approach and kind of really speak to the legacy and, you know, the future of the business, so that person can stick around and, you know, and say, hey, it's not just about me earning the cash, but it's also about my legacy continuing on, especially if they don't have a family member they can pass on their business to. But, you know, then you have another category of sellers who are like, hey, I'm not willing to retire just yet. I think I can actually improve my business because like a lot of our consumer product clients, right, a lot of them are sitting on a lot of inventory and things like that. They're saying, hey, maybe 2023 is not the right year for me. Let me improve how I'm doing my profitability. Maybe I'll come back in 24 because I could really increase my value at that point. And if they're not willing to wait, then, and if they're promising great results, then yeah, earnout, I would say both as far as cash is concerned and earnout and an equity component as well are great tools to sort of bridge that gap in valuation.
Yeah, I would add to that. I've heard for a long time that, oh, there's going to be this big turnover with kind of baby boomers who are wanting to retire, and COVID kind of delayed some of that, and these people are going to be coming out to the market. And in actual fact, I have not seen as much of that as I had anticipated. I think people are holding off a little longer because I think with interest rates going up, and some of the other macro issues in the world economy, it's impacting valuations, and people are deciding to hold off a little more than I think they had maybe anticipated pre-COVID.
I guess the way I look at it is that in 2008, we were at the beginning of the baby boomer retirement wave, and now we're midway through it. And how long can you hold off?
I totally agree with you.
Right. So a great example is that in 2008, I was talking to like a mall magnate. He's like, on paper, I'm worth $400 million, but the reality, and he owned like the best of the best malls in the country. Right. And but the reality is, I'm in the red on all my malls. Sure. And there's no turnaround for me because I'm 75 years old.
Well, right. The question is he going to sell now? No, he's not. He's kind of in a bad position because the malls are not in great shape, and he's older, but he really doesn't have a lot of options here because there's not going to be buyers at the kind of numbers he was hoping and expecting and anticipating.
When do you buy the assets rather than the business? Maybe you guys can, because another thought of you know, self-financing and things like that is, do you buy, maybe the business isn't worth that much, but the assets are worth a lot. So we had a guy who was a 5 and dime operator, and he owned 2 block long warehouses in Brooklyn. Sure. Right. And those together are worth $100 million. Right. The business is worth nothing, importing junk from China.
That's creative ways of resolving some of these issues. The fact of the matter, it's not what I do, it's what I did as a lawyer. I was an M&A lawyer. I did a lot of that work. But right now I'm a minority investor, so that's not.
Yeah, you're
really the
doing
place
growth,
I am.
absolutely. Yeah, you're looking at much younger guys who are not anywhere near retirement probably. So.
You moved to greener pasture law practice, but I think that in your example that you gave, right, somebody who owns these malls and maybe they'll, I mean, you're right, they should probably hold on to it maybe, but think about a business
can.
where, if you can, but think about a business where, hey, I have no, I have no other option but to grow. How much, and in order to grow, I have to actually put in funds into my business. I have to buy more warehouses. I have to expend money. Am I willing to take that risk on my own? Or do I bring on a minority investor or, you know, another investor sell my business? That's the difference. And as a buyer, frankly, you always want to try to buy the assets of the business anyway to get the step up. So that's just.
I would add to that a little bit. So one thing that we're talking about in the boardroom is succession planning. Obviously, cost of capital is much more expensive, whether it be cash or leverage. And so that time horizon to exit is only going to be extended, regardless of if you are, you know, a baby boomer or if you are long the tooth in terms of the trajectory of your business. You're going to have to raise some sort of capital because that exit horizon is going to be extended. And that probably means that whatever capital you're using is probably going to be structured, whether debt or equity. A lot of that capital is going to go towards servicing the debt or equity and not just for growth capital, so that what you were thinking your growth trajectory is going to be is also going to be extended, so it compounds. So what do you do in order to mitigate that? And a lot of the conversations that we're having is that succession planning. And part of it is bringing expectations down in the boardroom as well as with the owners of these businesses. Because on paper, if they think their business was worth 2 years ago $400 million, that's great. You own 100% of that business and it was worth $400 million 2 years ago. Wonderful. If you went to go sell that business now, it could be worth 200, and it might be 3 to 5 years from now when you're going to sell that. So why don't you bring in that next layer of management, give up some of your equity, and then maybe you'll be able to expedite that growth plan, or it might be extended, but now you have the next person and that equity still might be able to have that upside. But today it's probably worth half, or even if you can transact, maybe it's even worth 0 if there's no buyers out in the market. So we're trying to have kind of that harsh reality conversation in the boardroom and think about kind of that going forward as well.
You can't see.
And Nishita, I wanted to pick up on that if you would just for a second there, particularly with the various alternatives that are available today that weren't available a couple of years ago to companies that are now ready for the exit portion of things, secondaries, things along that line.
Yeah, I think that, you know, when the exit environment has evolved, and I think similarly to some other people here, we focus on technology companies and the volatility of the tech markets, but then overall market and potential exit opportunities. Originally, you know, 15 years ago, it was usually strategics that you were selling to, and they'd pay the premium multiple because they thought about synergies and they had a lot of cash on hand. In the last, call it 5 to 7 years, a lot of sponsors have emerged, and there's over $1 trillion of dry powder sitting on the sidelines. And so they actually surpass strategics in terms of multiples they're paying. Now, if I were to canvas and say, you know, even a couple of years ago, 3 years ago, what that bifurcation or what those buckets were that we would sell to, it was sponsors first, they're paying a premium, and they would expedite the sales process, then strategics backed by financial sponsors, then strategics. But now you have this new form of capital, and it is a sleeve that we think about, which is the secondary market, whether it be continuation funds, providing liquidity for a GP or LP-led secondary, and even growth capital opportunities. It is now something that we actually think about we can no longer exit in that 3 to 5 year period. It might be 5 to 7 years. So as we get to that point in our funds or for some of our assets, can we package it together, raise some secondary capital as well as primary if those funds are not investing, and then extend that time period, providing liquidity to our investors, but also providing some opportunity for growth capital. Now, it's also when those transactions occur, they're probably at a discount to NAV or wherever you're holding them, but it gives you the optionality of holding on to an investment that is a very large and growing market opportunity that's only going to get bigger over the next decade.
Yeah, Mark had another comment. You can't see his hand.
Yeah, so so actually I'm following up with Nishita, who's giving all this germane comments here, which is at some point, can somebody talk about the journey of professionalization? Because I mean, like the landscape has turned into a desert from an oasis, right? And I'm getting calls from people like, I gotta, so I have a guy who's like got a $200 million a year in revenue company, and he's like, I gotta raise capital because all of my debt products are going up. And he's like the only owner, no private equity, no other owners, et cetera. So what's your CFO said? I talked to the CFO. He's not any good at all. He's like, has never raised capital before, right? So if you guys talk about the journey of growth, and then also how do family offices get into secondaries? Secondaries were golden in 2008, but now there's these humongous secondary funds out there. And if you guys can talk about strategies for secondaries, to get involved, that would be great too. So I'll turn it over to you.
Just in response, I don't really talk about secondaries, but I actually was on the phone this morning with a company in the UK who I'm putting money into the business because they have potentially a very large company that looks to put some money into them and probably acquire them. They're really a strategic, but they really didn't feel they had the sophistication, the know-how to do the negotiation, to deal with this larger entity that's coming in that's highly sophisticated. So we came to terms in which I'm putting in money into this business, but really to a large degree, I'm acting as an intermediary for a subsequent sale of the business. I think it's probably going to be an initial small investment, kind of a joint venture, and then assuming that the model plays out, it'll probably be a 20-80 deal where they'll put in 20% now, they'll see if the model works, and then they'll put in the 80. And I'll get to ride along because I'm bringing in the ability to negotiate the deal.
Sure. Yeah.
So that is a way for, certainly people that want to get out, want to exit, to bring in someone with some sophistication who will also put some chips on the table to put, to make an
I'm just taking the talent journey of professionalizing an operation. It doesn't seem to be trivial.
No, it's going in and be able to actually help that business requires a level of sophistication that, the founder owners, they're good at sales, but not necessarily leveraging this into a sale of the business. And that's a whole different skill set.
Even just continuing operations because of this terrible financial climate that we're in is not good.
Well, one of the things I would add, and actually it really applies to both Nishita and I, a little less to the gentleman from Woodside. The layoffs that have recently occurred in Silicon Valley with Google and Facebook and Meta, or I guess Meta is Facebook, but all of the different technology companies that have had layoffs actually is pretty terrific news for us in the technology space, because Google, for example, they didn't selectively pull out individuals. What they did was they actually laid off entire divisions, entire departments. You have this entire group of people that have been working together to build a product. Well, they're going to go off and they're going to build that product on their own. And eventually they will be an acquisition candidate for Google down the road. For people like me, it's an opportunity to go find those companies and invest in them. I think it's going to be kind of a renaissance of this. Some of the smartest, most talented people in the technology space who are now going to be off on their own, building their own products and services that I can now invest in. So I'm actually very optimistic about this coming couple of years.
Well, so I'm looking at it as like, some of us have gray hairs here. It's a return to fundamentals, right? Because the market was really warped by this funny money that's been out there, right? So
yeah, I agree.
Yeah. On that, I mean, it is changing, right? Where if you saw, and I can, again, speaking, as Jack said, to the technology markets, but you saw kind of that correction occurring in consumer unprofitable in the public markets. Then you had profitable enterprise or B2B software, and the correction on the consumer not profitable is a 70% decrease in valuation, whereas enterprise profitable tech companies was a 30% decrease. Now that trickles down to pre-IPO, middle market, and lower middle market, where I play. And if you just think about that, what is now changed in terms of selling businesses, it's no longer growth at all costs. It's people were not even thinking about capital efficiency. Now it's back to fundamentals. And it's funny, and Jack, you'll remember this, that even 15 years ago and how you underwrite and what you're thinking about is now back in vogue, but it was kind of traditionally what you should be underwriting to from a value creation standpoint. So you're thinking about, and especially in the tech world, the rule of 40. So what are you growing top line at in terms of your growth rate and adding that to your EBITDA margin? I have also heard that if you're not profitable, don't get out of bed, right? Don't go out, don't raise capital, don't sell your business, because if you're not profitable, you're not efficiently using capital, then you're just not even going to get the right numbers to sell your business. So thinking about the rule of 40, thinking about sales efficiency, capital efficiency, what does R&D spend as a percentage of revenue? All of these things are now, you need to check mark those boxes. And it can't be, medium to okay. It has to be great in order for people to provide you with the valuations you want. So I think, Tanya, you said this, which is a lot of people are just waiting. And how do I get there? And what do I need to do to improve the fundamentals or KPIs of my business to then go out and raise the capital? And those businesses that can do that are actually still commanding premium multiples to the tune of 2021. So if you're out there and you can do that, there's still a market for people bidding on those assets.
Hey, George, I want to direct this over to you a little bit here, if I could.
Mark,
And specifically, I want to talk about, just you can wait a minute, we'll get there. I understand. I can't hear you. You're coming in and out.
Okay. Mark, there's someone in the audience here that has a question. You can't see the audience.
That's all right. I'm glad you're raising and letting me know. Let me finish up with George. She can come in after that. So you're in the business of connecting sellers to buyers. I'm particularly interested, what do the buyers want in this market right now? How is the bar changed for them?
Well, the first thing out of their mouths is we're no longer paying for strategic value. So they're looking for bargains. They're also looking, in most cases, to supplement a product portfolio, expand geographically, some method by which they can get outsized revenue growth. And so convincing them with it's interesting, Nishita, the notion of profitability sure does matter a lot more than it did a year ago. And so an awful lot of that conversation ends up being, how valid are your projections? Is your forecast decent? Are your customers for real? Et cetera. So the first answer, Mark, is looking for value much more than they did even a year ago. But the programmatic buyers are seeing this as just a cycle, and so they're actually doubling down. And I agree with the earlier comments on the amount of dry powder out there. I'm finding, going along with this notion of value, much more prevalence in earnout components and other risk mitigation techniques. There are an awful lot of those, and it's almost every deal has some component like that, and they're taking longer. The degree of diligence is much deeper than it was.
Great. Jack, if you could bring in that question now, that'd be fantastic.
Okay, great. Hey, Mark, it's Rob Colorino.
Hey, Rob, how you doing?
You can hear me. That's good. Yeah, I'm here in LA. Pardon if you addressed this a little bit before, but with regards to financial M&A, financial companies, just given what's going on with First Republic and the recent Silicon Valley Bank, and that is even before, I think, some of the market write-downs on real estate portfolios. I was curious if there could be some commentary on that environment in an efficient way. I mean, do those deals happen? Are they going to be accretive down the road, or is it kind of? It seemed like there would be more bidders on the First Republic than there was.
Jack, do you want to take the first stab at this?
Sure. There are a lot of macro issues affecting our environment. There's a video game that I play, was looking forward to a sequel, and it turns out that the video designer was Ukrainian and was just killed in the war. And so it looks like we are not going to have a sequel to that. Lots of technology comes from from China, from Eastern Europe. Everyone knows India, but actually there's so much talent in Eastern Europe that we don't think about, that it impacts my space. First Republic Bank happened to be my bank. I think most people were aware First Republic Bank was my bank. After Silicon Valley Bank went out and Signature Bank went out, I think most people were aware that First Republic Bank was going to be in trouble. It impacts my industry. People get nervous. Family offices saying, you know what, I'm going to wait. I'm going to hold off for a while. It means that people are a little more constipated, in terms of making the investments that might make some sense. On the other hand, the silver lining is valuations become a little more realistic. I do think in my space, valuations became a little aggressive. It became very tough to find a deal. There was a wonderful deal I was looking at, also happened to be out of the UK, that did relocations for very large companies. And I put in a bid of what I thought was aggressive, was 10 times ARR. The company was not yet profitable. What Nishita was saying before about not having cash flow, not being profitable. A multi-billion-dollar private equity firm came in and gave them an offer of 25 times ARR. Well, I can't compete against that. In fact, I actually said, take the offer. I would take the offer. And I don't think they would get that today. And so I do think to some degree, from buyers' perspective, there are going to be some opportunities right now that actually are going to present themselves fairly nicely. But, you have to be willing to write a check. When times are volatile, there are opportunities.
Just a question aimed at you, which is that, there's buyout, private equity, but to me, there's a world of opportunities in like recapitalizations, capital stack restructurings, et cetera. I mean, it seems like that whole world is out there. There's a lot of experts who don't have funds who are trying to make that happen. And they're not fundless sponsors either. They're turnaround guys, which I found are not very good at raising capital, right? But right, I mean, so you got to marry a banker with a turnaround guy. So maybe you guys can talk about that space that's inside, that's not buyout, but it's inside of fixing companies, maybe a little bit.
The folks at Woodside probably deal with that on a regular basis because I'm looking to do the fixing. I mean, I go in and I work with companies and I bring in people that I feel I trust, that I've worked with before, that I think are really good in the space. So there was a company, and again, just another example, that I found this really great, it was geolocation company that was far more advanced than anything else in the marketplace. Despite the fact that they had the best product in the marketplace, they were absolutely terrible at sales and marketing. And so nobody knew about them. And so just because you built a better mousetrap doesn't mean the world beats a path to your door. I could not find a specialist to put in there to make the investment. If I could have found that person, I would have put money in a second. But sometimes, you have to know the right people. You have to have the right connection. They really needed help and I couldn't do it. And so a lot of it is, who I have in my Rolodex and what I can bring to the table. Someone like Nishita, coming from a multi-billion-dollar organization, has a lot more resources than I'm going to have in terms of finding the specialists, the expertise. But I like to roll up my sleeves and get involved personally. And if I don't feel I can bring value, I'm not putting money on the table.
Maybe George's comments.
We half the deals that come in our way have some significant issue that needs to be resolved. So, and I think I'd go back to the comment of the layoffs in the Valley have been good. Everyone from ranked startups to companies that need to, solve these kinds of problems suddenly have some talent that they can tap into. Thankfully, if you've got a decent Rolodex, you can find them and Jack, you ought to get to know each other. There may be an opportunity or two.
Hey, George, could you also speak to the speed of getting the debt into the company? Because obviously that's now a longer process and it's impacting deals. So could you speak to that a little bit?
Yeah, the criteria, if it's a bank-based lender, the level of diligence is enormously longer and more complex than it used to be. And the number of, special terms that go with it have become much more difficult. I've got an active client where we went out to 25 lenders over the last 2 or 3 months. And, the traditional banks just couldn't get their brains around this company. And over the course of the deal, most of them dropped out. So we've had to find specialized lenders that are not banks to service it, who are willing to be slightly creative, and then there's some real limits to how much total debt that they'll allow.
One of the things I've heard, Nishita and Tanya, is that sometimes when people are selling the business, or maybe you're the seller of the business, they ask the purchaser to backstop the leverage portion of the deal. Have you seen that or come across it?
We definitely have, and we want to as much clarity as possible of who the financing is providing the financing in those transactions, and you want to waive as many financing contingencies as possible. I think it's going to become harder and harder, and I know that twofold. One, because traditional banks, and I think there was a question in the chat, are banks lending? We found that they really aren't, or they're taking, as George mentioned, an exorbitantly long period of time to be able to get there. And I'm a big believer, probably also a nice plug for myself and our team, but big believer that a lot of the lending is going to go into private lending and is already gone there, and just not be anything OCC regulated. And so what we're seeing also up market from us, from sponsors, or even strategics that are providing financing contingencies, is that they may not be able to line that up either. And so the duration of closing a transaction is also a lot longer. And in some cases, they're trying to use, is what Tanya mentioned, seller's notes, earnouts, or other things, so they don't have to rely on the banks to get the deals done.
I mean, the only thing I would add to that is, I think the other thing that we had seen was that I think some private equity funds are also being really creative and using a combination of debt and equity, frankly, to secure their investment. And this way they're secure. And so, yes, the transactions are taking a little bit longer, obviously, because you do have that financing contingency, where 2 years ago, nobody would sign a term sheet allowing for that, or a purchase agreement allowing for that. Not that's just part of the game, but they're also being creative and sort of doing that combination. And that way they can kind of secure their investment, in addition to all the other tools of seller notes and earnouts and everything else.
Hey, Mark, 2 minutes. I think Gary Saka had a question. Gary?
Sure.
Yeah,
Fire away.
I wanted to just say that, we had a group here, and it was a group of financial executives, and it had a lot of people from banks around the world, and myself more as an observer of the scene. And so what happened is that the banks really, it seemed like the most important thing they were trying to do is increase their spread. That's about 60% said that they had been approached by people to increase the spreads, or they thought they were going to do it. About 20% tightened covenants, and another 20% just wanted to get some more income, really press them hard on selling other services. So that, banks obviously have a lot of services, and we talked a lot about the scorecard, because a bank makes a lot of money off you. They have a scorecard, of course, an equity scorecard. And so we tried to say what could these are medium to small sized companies, try to keep that liquidity. But so that was my comment there. But I guess the one question for Mark and the panelists is, what happens really if we just have a complete crisis of confidence? I mean, these banks, just in the time since we started the conference yesterday morning, PacWest went down a lot, and then it went down again today, and Western Alliance. Is there anything to stop that, short of raising rates or something, raising the deposit limits, or is that just something that could balloon into other kinds of things? So anyways,
Well, I think Nishita hit on it a little bit. It's a lot of this is now being pushed off now. You're talking about different layers of debt, right? So you could have, what the banks traditionally have put in. You have your mezz levels, you have your higher risk levels, and those are usually taken up by the funds. But with these lower amounts of risk being associated with some of those things, they're willing to move down and take those. And I'll let George and Nishita speak to that, if you would. And then we'll wrap it up.
Yeah, I'm finding a combination of rates and covenants becoming more prohibitive. And the and the openness to even deploy, I think, has decreased a lot. It's tough sledding on the debt side right now.
Yeah, I think
Nishita?
gone are the days of the cheap capital that you're getting from banks. And so you're finding more structured debt and structured equity that's being layered in. And obviously the underlying interest rates are going up. So they have to get their return somehow. So you're layering on top of that as well. I think that's going to continue. You have a lot of private lenders out there that are lending and understand kind of that risk return. They'll ask for equity kickers. They're going to ask for a lot of covenants. Might take board seats. But there are a lot of those still out there that are lending. And I think they're going to do quite well if they've raised funds in this market.
Fantastic. I want to get everybody's final, what's the takeaway from this? What should people walk away from today's program? We've touched on a lot of different things. You guys did a great job. Tanya, I'm going to start with you since you haven't spoken in a while. Just give us your 1 minute summary here.
I know one thing I would say, just to kind of add to the topic that we were just talking about, is, when we're talking about the opportunity for buyers, is if you can do an acquisition investment without using debt financing, then you're way ahead of others. Hopefully things will hopefully start turning around, but there's still a lot of opportunity out there. And as long as you're mindful about what you're looking for and set expectations ahead of time, then I think there's still a lot that could be done this year as far as M&A.
Jack?
Yeah, no, I agree with Tanya. I think there are going to be some really terrific opportunities for investors. When people pull back, that's when you should be writing a check. It's a good time to make some really smart investments at good prices.
George?
It's a glorious time for new technology. The amount of innovation we're seeing is just incredible. And it's not just about generative AI. We're seeing such interesting, innovative approaches to problems that have not been solved well in the past. I'm very bullish.
Nishita, final word here.
I agree. I would also say multiples may be coming down, but it doesn't always mean the assets are good. And like into the fact that you won't buy a shirt on sale if it's too small for you. And then also headwinds tend to wash out the lesser competitors, whether it's for the underlying assets or peers. So if you can pick the winners, you can probably leapfrog your competition.
Well, this could have gone on for another 2 or 3 hours, but I thank you for your time, your insights, and for being, very short and to the point. And thank our audience for the questions they chipped in, and Marty for the opportunity. So